Clients ran out of appeals.
Call the meeting to order at 8:31. Okay. Let's see. Jim?
I pledge allegiance
To the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay. We have public comment. Anyone? Public comment? No public comment. We'll move right into the consent agenda. Is there any discussion on any of the consent agenda items needing separate action? The minutes, retirement report, preliminary financial report.
The retirement report is still showing last year's in the fiscal year 1920.
I think we were carrying,
Calendar.
Because before it just showed this year's total change.
oh, okay. We'll get that corrected.
Okay, any other discussion? Okay, do we need, by unanimous consent, we can approve the consent agenda and move on? Is that okay with everyone? All right. Okay, next item on the agenda is investment matters.
We have Callan here to discuss, give us a quarterly update and talk about
I'm sorry, I have to.
how well-ish we're doing.
Maybe, I'm sorry, my Wi-Fi is not working.
Oh,
Can I
well.
escape my
Everyone's
internet?
having problems.
Okay.
So,
Yeah, you need tech support.
Public library.
Before it
is
gets
maybe
started.
working. And then you just hit connect on the public library. Maybe.
It's just, yeah, it's gonna be
There we go.
slow. Oh,
Hmm.
what did I do?
nothing.
Okay.
It's
Okay.
twitchiness, so.
Yeah. Sorry about that.
Nice to see you.
It's good to see you. Yeah,
We're
thanks for having us.
happy to hear from you, and you're gonna do the summary first, or on your quarterly?
Yeah, so we have kind of a lighter lift today, if you will. We're here just to talk to you about performance, to let you know how the investment portfolio has been performing through the end of September. A lot of times we meet with you and we also have a monthly flash report, but your meeting's a week earlier because of the SACRS conference. So we don't have a month of October numbers yet. We'll have that in the coming days though. Just to remind all of you where we're at in our process, we conducted an asset liability study for you, and we decided to take a close look at infrastructure. And we decided not to take a look at the other investments. Callan conducted a search for an infrastructure manager, which we reviewed this Monday morning. We have an internal, I think of it as an investment committee, which reviews recommendations about managers. And that investment committee approved two funds which we're recommending for you to consider. It's JP Morgan and IFM. They're the largest, longest tenured, most diversified, open-ended infrastructure funds for you to consider. And our current objective is to have them come in and talk to you in December to give you a feel for, okay, what are these investments? Because we've gone through a few educational sessions with you, but at the last meeting there were still some questions. Okay, what is this? I kind of heard what kind of generalities about what infrastructure investings are. I want someone to come in and tell me exactly what are you buying and what are you doing. So in December, we're going to have two firms come in and spend the first half hour saying, okay, what is infrastructure for each of their respective presentations, and then why might they add it. So they'll be doing that at the December meeting. Okay. Today's meeting, we're just talking about performance, and so no action items at today's meeting. Okay. One other preamble is after we look at infrastructure, decide whether or not to fund and who to fund with, if we decide to move that way, we're going to roll through and look at your individual asset classes again. So is the domestic equity doing what we want it to do? Is international equity performing the way we want it to? The bond portfolio. So that's going to be a project for us to go through in 2020 after we get through with infrastructure. Okay, so that was the level setting, and it was also, do you all have the presentation on your iPads? Okay, great. If we flip ahead to page 4.
Are we looking at the full report or the performance?
No, it
summary?
should be the summary report.
All right, thank you.
Yeah. So if you look at page 4, here we have a snapshot of 4 charts which we think do a good job of trying to explain what's going on in the economy, and then from there we can come to an understanding about what should be driving markets over the long term. So at the upper left-hand chart here, we show quarterly GDP growth for the past 20 years. And as a lot of commentators have been mentioning, we have been in a low growth but steady growth environment for a number of years. And that continues to be the case, where the United States continues to grow at a roughly 2% real GDP growth rate, which is down a little bit from 3 quarters ago, but is still moderate and positive growth. This is probably, I would say, a good story, because you hear a lot of headlines about what other people are worried about. We must be headed towards a recession because the expansion's been going on for 10 years. And we have issues with trade wars, which is a drag on the economy, without doubt. Nevertheless, the economy remains strong and growing. You saw that unemployment rate was released, I think that was last week, and we're looking at, I think, 3.6% unemployment rate. So the consumer, which represents 70% of the economy, has a paycheck, and even though wage growth is not as significant as it was earlier, it's still growing at about a 2.5% to 3% clip, which is good. Okay? So overall, the economy looks decent, but there are headwinds going forward. If you look at the right-hand chart here, we look at inflation. And you'll see the blue line is CPI-U, the more steady number. And then PPI is the purchasing index, and it's a little more volatile. But the blue line has been pretty stable, but at 1.7%, it's a little bit below what the Federal Reserve is targeting, which is 2%. This means that the Federal Reserve wants to get this number up, which in part is why they've been easing, cutting federal fund rate 3 times now since its most recent peak. On the bottom left-hand chart here, we look at the yield curve. So this is how much investors earn by investing in U.S. Treasuries at different maturity rates. The yellow line is where we were 12 months ago. The blue line is where we were at the end of September. It was a pretty big drop. And this drop, in fact, surprised a lot of investors. A lot of bond managers were underweight interest rate risk because they didn't anticipate the magnitude of this drop. And a lot of this drop had to do with the market predicting that the Federal Reserve would be cutting interest rates going forward. Okay. Now, the United States interest rates are low, but on the bottom right-hand chart, you'll note that we're still above where a lot of other countries are. So low rates here, but it's still high relative to places like Japan, Germany, and the United Kingdom. So we, the United States, remains a place where investors want to put their money, which is propelling our dollar, which is leading to our investments to do better than their investments on a US dollar rate of return. Okay? So that's a little bit of the economic backdrop. Let's flip to page 5 and look at the chart on the right and say, okay, so what have the implications been of that? And I'm looking at the 1-year column here, and there are a few implications there. What's the highest returning asset class for the last year?
Long bonds.
Long bonds. Who would have thought, right? Long bonds for the last year are up 22%. So outpacing the stock market, which is at an all-time high, right, today. After that, what's the next highest returning asset class? Well, actually, technically, it's more. It's more than long bonds.
Gold.
Gold.
I don't want to correct them.
What's that? You didn't want to correct it?
I saw that.
So why is that? Why is gold up 23% for the last year?
Fear.
Fear. Where do I put money? Where do I preserve wealth if I think the value of currency is going to go down? Because inflation is going to run higher than yields. So today, driving up, Claire and I were listening to the radio, and the 10-year Treasury is 1.8%. Inflation is printing 1.7%. So I can give the government my money for 10 years and earn 1.8%, but inflation is going to be about the same. So I have no real return relative to inflation. What if inflation is higher than that over 10 years? I lose purchasing power. My dollar is worth less than it will be in 10 years. So some investors look at that and say, I would rather be in gold because I think gold will keep up in a real purchasing rate over the long run. Okay. Gold also can be extraordinarily speculative, and it shouldn't produce a real return over the long run, which is why we don't invest in it as an asset class. Nevertheless, showing this number lets you know what's going on in the market.
And it doesn't pay a dividend.
That's right. That's right. It has no economic earning. It doesn't make money. It's not like a company earning something. Okay, a few other things over the last year. U.S. stock market, we're at an all-time high today, but large cap stocks are, over the last year, are only up about 4%. Year to date, they're up 20+%. So keep in mind, fourth quarter last year was an awful time period for the U.S. stock market. It was down about 20 percentage points. And then when we look at one-year numbers, of course it includes fourth quarter, which is a huge drawdown, even though year to date it's up 20-some%. So for the one-year time period, large cap stocks only up 4%. Look at the gap between large cap and small cap stocks. Large cap stocks up 4, small cap stocks down 9%. So the rally over the last year has been really confined to very large cap companies. And if you invest in companies that are not just large cap, you underperformed your benchmark, and in some cases meaningfully. Okay, so small caps down 9%, large caps up 4%. In the US equity portfolio, we intentionally overweight small cap stocks because they provide a risk premium in the long run, we believe. And then your active managers on top of that tend to be more equal weighted than market cap weighted. Fancy way of saying they tend to have more small cap exposure than large cap exposure. This one factor alone has a big explaining value about how your US equity managers all rolled up together have performed relative to the index over the last year.
So Greg, how do they bake in the dividend in these, say our larger small cap stocks over a certain period of time and they go up or down? How is the dividend baked into that?
So
if
these,
the stock didn't go up at all and it paid us 5% dividend, you're booking it at a 5% appreciation?
yeah, so all of these returns here on page 5, and all the returns for your actual investments in the book are total returns. So they include dividends and changes in price. So if you have that 5% dividend and the price didn't change, on this page and then later in the report it would say you earned 5%. So it's included. But what's important is that a lot of times when you hear the Dow Jones Industrial Average, it's up or down in a day, that does not tell you, you know, companies are paying you a 2% dividend on average per year on that. So when you hear that market talk, know that that generally doesn't include dividends, but our performance reports do. Okay. So the gap between large cap and small cap, really meaningful, and it impacted your portfolio when we get to that. Another thing to point out is the gap between US stocks and international stocks. And I've been talking about the 1-year time period, but really this extends for all time periods that we're looking at here, quarter, year, 5, and the gap over 10 years is truly surprising, in my opinion, where US stocks have far exceeded international equity stocks. And that's for a couple reasons. One, US has been growing more than international, but two, that currency effect I was talking about on the previous page, where we have higher yields, we have higher growth. Foreign dollars want to invest in the US, it's propelling our markets and it's suppressing their markets. So international stocks have been a sore disappointment for the last year and longer time periods. Okay? And naturally, you invest in international equity stocks as well. Bond portfolios, the aggregate bonds are up 10% for the last year. So your PIMCO and Dodge & Cox portfolios have been performing really well and more than we would expect them to earn going forward. Going forward, we think if they eke out a 2 to 3% return, that'd be great. We can't expect another 10% return like they have over the last year. Okay, so I share with you what's on page 5 just to put your portfolio's performance in context. One other thing that I think is really interesting is on page 8, and I think that'll be the last chart that I stop on before handing it off to Claire for talking about your actual portfolio. And what on page 8 we're looking at here, it's busy, it's a lot of numbers, but the columns are industry categorizations within the S&P 500. So materials, industrials, energy, financials, etc. We're looking at year-to-date returns here, and I mentioned that the stock market's up double digits, but what's really interesting is some of the leaders are not the companies you would or industries you would generally think would lead in an aggressive growing market. Real estate, staples, utilities tend to be defensive sectors, sectors that do well on the downside, not necessarily do really well in a raging growth market, okay? A couple things going on there. There's been a rotation out of tech type companies, aggressive growth companies, into more value-oriented companies. And then these companies are also more sensitive to changes in interest rates. So utilities can be a bond substitute. Real estate is often a fixed income substitute. So as yields have come down, these sectors have gone up in value as well. A number of your managers aren't necessarily overweight utilities, aren't necessarily overweight staples or REITs. So this area has done really well in part because of interest rates coming down, but you're modestly underexposed to these areas relative to the broad market. Okay? So that's kind of the backdrop. That's what's going on in the economy and the capital markets. And now Claire's going to show you what happened in your actual portfolio.
So I'll start on page 20. And Greg kind of set the tone that if you flipped ahead a little bit, the quarter was disappointing on a relative basis for the portfolio. And that bleeds into the year. So we'll get there in a minute. But we thought maybe we'd actually start on the asset side first. Often we go straight into returns, and those returns are important, those numbers are meaningful, but what it means for your assets and the total portfolio is really how you pay benefits at the end of the day. So on slide 20, we thought it was interesting to look back at the total ending market value, so assets in the total portfolio over the last 15 years. And that is really significant growth. So sometimes we talk about this plan as being a smaller public pension plan. It's not so small. It's over $500 million, and 15 years ago, you were under $250 million. More than doubled in 15 years is pretty significant. And this shows the down draw in 2008. So through 2009, the portfolio was down about $125 million. That was made up net of benefit payments by about 2010, 2011. And now you're up on the top right, just under $550 million in total assets. So that has a significant impact on, again, your ability to pay benefit payments. And so slide 21 looks at where that growth has come from. And in the top chart, we look at calendar years for the last 10 years, 2009 through 2018. The blue bar represents estimated gain or loss, so that's investment results in dollars. And then the green bars are net flows. So pretty consistent net outflows to pay benefits to beneficiaries of the pool. And then the blue bars are more varied, as you would expect, but generally positive over the last 10 years. And there's a couple that stand out. So 2017 was a notable year. You saw about $84 million in investment gains in the portfolio. 2018 negative. And then 2013 also notable at about $71 million in investment gains. And then the bottom half of this page looks at year-to-date 2019. So again, I mentioned the quarter is somewhat disappointing from a return perspective, the year disappointing. But when we look at just the year-to-date period, there's an investment return column, third from the right. For the first 3 quarters of 2019, the portfolio has seen investment gains of just under $61 million. So that's notable to me, because if we see a positive return through the 4th quarter, 2019, despite the way we've talked about returns, could actually be one of the bigger years from an asset investment gains perspective. So I'll just leave that there. Slide 22 gets into the portfolio actual asset allocation versus target. Right on top of target, as expected, as of the end of the quarter. We've talked a fair amount in the last few quarters about asset allocation and if there's a desire to change the asset allocation going forward, but as of now, The portfolio is still at about 78% growth, 22% fixed income, and those growth assets are invested in public equity, domestic equity and international, and real estate. So no changes there. 23 looks at actual asset allocation versus target over time. Very consistent. And again, we're considering, well, should there be a different slice? Might we want to see a change in the asset allocation going forward? The next page, again, capturing what other public plans invest in versus what this portfolio is invested in. And circled in orange on the left-hand side is what this portfolio holds. The gray distribution represents the range of asset allocation of other public plans. And then the asset categories on the right are asset categories that you don't invest in, with the far right, the real assets category being one that we're considering further investigation into within infrastructure. So again, what we talk about consistently, you have more public equity than peers because you don't invest in the categories on the right-hand side. And that affects how your performance looks versus that peer group distribution. Slide 25 looks at more detail in terms of how all of the individual managers in the portfolio hold your assets, what dollar amounts are in each investment manager, and how that's changed over the quarter. Overall, for the quarter, about $2.75 million went out in benefit payments, consistent with past years. And you saw about $90,000 in $90,000 in investment gains. So that's a negative $2.5 million for the ending asset value for the portfolio over the quarter. So that tells us the return was about flat, and we'll see that for the quarter. '26 has returns for the total fund, so that's the green dot, versus the benchmark, which is the orange triangle, and that benchmark is the passive investment of your target asset allocation, or passive implementation, I should say. And then versus peers, so the gray distribution representing the 10th to the 90th percentile of a public plan peer group. And there's a couple things that stand out to me on this page. I drew a line right after the year, the last year. And if you look to the right of that line, anything 3 years or longer, performance looks good, very good. Anything to the left, so the last quarter and year, does not look good, disappointing. Specifically for the green dot, so that's your actual portfolio. The other thing that jumps out to me is that the orange triangle, so your target asset allocation, is actually done quite well across all time periods. So 3 years and longer in the top 20 percentile across all time periods. For the last quarter, about median, and for the last year, in the top half, 37th percentile within the peer group. So implementation of the total portfolio has led to underperformance in the last quarter and year. The other thing I want to note on this page is that there's a missing column that's in my brain as I look at it, and that's year to date. So Greg talked a lot about what's happened to year to date. He mentioned that the fourth quarter of 2018 was particularly challenging within the markets. It was particularly challenging for your portfolio as well. So baked into the last year is the fourth quarter of 2018. If we take that out, this portfolio is up about 12.7% year to date and ranks in the 36th percentile of the peer group. So for me, I think about the fourth quarter of 2018. That's a time period that we wouldn't have expected your portfolio to do well, and it didn't do well. Now in the bounce back, first quarter of 2019, your portfolio soared back as we would expect it to. So again, this performance is actually pretty consistent with what we would expect. It's consistent with historical time periods. It's just that the last year has been underwhelming when we keep that fourth quarter of 2018 in there. Again, if we see a positive quarter through the end of the year, I would expect that number to jump up pretty significantly. Now, from an absolute return perspective, again, the recent quarter was just about flat. Your benchmark returned 58 basis points. For the last year, the portfolio was up 1.7%. The benchmark was up 4%. Over longer time periods, last 7, 10, 15 years, portfolio's up about 8%. Pretty good annualized return. Almost all black numbers though, right? So we continue to see gains, all positive absolute numbers. We break performance down into additional time periods on 27 and 28. Fiscal year to date, of course, is just the one quarter. Fiscal year 2019, again, that bakes in the fourth quarter of 2018, and we talked about that last quarter, down about 2.75% versus target. And then if we look across other fiscal years, and as we've talked about over time, your portfolio tends to be one of the top dots or somewhere near the bottom. And that's the public equity driving performance versus peers. If we look a little bit longer, roll those time periods into rolling 3-year time periods, that's captured on slides 28 and 29 and 30. And when we look at rolling 3-year periods, you're always in the meat of the distribution, which again, that's what you'd expect, right? You look over longer time periods, the performance over 1 quarter, 1 year smooths a bit more, and you're right in the meat of the distribution. So while peers may look different from you on a quarter-over-quarter or year-over-year basis, you do fall more in the middle of peers over longer time periods. More often than not, above median.
So I just wanted to, Claire and I were talking about this yesterday too. And, one thing that I really jumped out of the page to me on pages 27 and 28 is in the past we've talked about how you know our performance can look really different from peers on an annual basis because of the equity beta. And we've been looking at ways to diversify the portfolio to make it less reliant on equity beta. But what also struck me is the difference between the dot and the triangle in individual years can be really meaningful. So we've got a lot of exposure to active management risk, to the managers that we choose doing well or not doing well. The structure, the way we put together the portfolio to tilt towards small cap, to tilt towards EM, to have these tilts within the asset class, that exacerbates our reliance on equity market beta, right? So the gap between our dot and the triangle can often be a couple percent. And I think after we get through the infrastructure project, one of the things I think we should do is go through an active risk budgeting process and say, okay, how much are we willing to be different? Do we want to be different based on asset allocation decisions? Do we want to be different based on how we tilt the portfolio structure? Do we want to be different based on our manager selection? Because we've got all of those 3 levers, 3 dials, turned up. They're all turned up pretty high. And when it works great. When it doesn't work, it doesn't, we feel it. So I think next year we'll be looking at that as well. Okay.
So let's flip ahead to slide 33 on that note. This slide looks at, the chart at the top looks at attribution for the 1-year return versus the target. So in the blue box, actual return. At the bottom, the portfolio returned 1.68% for the year. Not circled as the target return at just over 4%. And consistent with what Greg was just pointing out, where does that underperformance come from? Well, it's highlighted in the green box and the red box. So asset allocation has detracted about 52 basis points over the last year. The portfolio remains really right on target, but it's just those small deviations when you see a significant difference in return from equity versus fixed income that can drive differences in asset allocation. Over time, you expect that to be much less than the manager effect. Your portfolio is designed to seek alpha from the manager effect. Now, what hasn't worked within manager effect? The public equity managers have underperformed. So domestic equity has underperformed by about 1% in aggregate, your active managers. That's versus the benchmark. And international by about 78 basis points. And that's in the last year. And what's baked into that is exactly what Greg was talking about. So any tilts within domestic equity overweight small cap, which is significantly underperformed large cap. That's baked into that manager effect. Also exposure to international small cap, which isn't in the benchmark for your international portfolio, or international composite, I should say. And all of that's totaled up to about an underperformance of the benchmark of about 1.88% for the last year. Now again, we keep going back to the fourth quarter of 2018. Most of that underperformance came in that one quarter.
Isn't this this big, the big news in here about depreciation in fixed income? That's really a function of just interest rates changing. It's not, it didn't really, there's an expression, you can't eat equity. You know, you can't eat appreciation. And then those bonds that we have, they didn't give us any more money. They're giving us the same amount of money that they gave us a week before, but so I'm just, it's sort of illusory to me that these gains look so significant within the bond portfolio. They're still the same bonds we had 6 months ago. And we don't sell them, we hold them. So we really didn't, it's the same price as what we paid for them in the beginning. And they're providing the same low yield that they, that they did then. I'm just troubled by putting too much emphasis on bonds in terms of what they really mean for our portfolio. I don't quite know how to put a period on that, but it just,
Yeah, so we measure.
voodoo.
Yeah, so, we measure, okay, if, in theory, what this is trying to say is if I sold everything today, what would my return be? So if you sold the bonds, they are worth 10% more today than they were a year ago. Because interest rates came down, the price of them went up, their earning power went down too. Forward-looking earning power went down because they're yielding less today than they did a year ago. But yeah, you would have 10% more money if you sold them all today and did something.
If you did, but the income that they're generating did not go up.
Went down.
It's like you have
That's
this
right.
office building.
That's right.
And real estate went up, not because we're charging more rent to our tenant,
Right.
but because we've got cheaper money.
Yeah.
And so is real estate really doing better? No, it's not. Real estate is not doing better.
Right.
It just looks better because they've got cheaper debt.
That's right. It appreciated, and the same could even be said for company stock. The price of these companies went up, but their earning didn't necessarily go up. Right? It's
Exactly.
just that everything is worth more money today. So these are very much past returns. They're not forward-looking earning projections, certainly at all. And if anything, it means that, our return expectation for bond portfolios are probably going to come down about 0.75% this year compared to last year. So we come up with an annual forward look for all capital markets, and our bond expectations for the next 10 years is going to be down pretty meaningful because interest rates came down so much, and you had a 10% return, which is a pretty outsized return. Yeah.
And that's gonna lever into a significant decline in our face value of our bonds, right? If interest rates go up 1%, then the face value of our bonds goes down
About 6.
about 6.
Yeah. Yeah.
Yeah, so leveraged.
Yeah. Yeah, and the reason why you're up 10% is because interest rates did come down, over this 1 year time period, over a percentage point. Percent and a quarter, which led to this 10% return.
I don't know if this is a good time to ask, but it seems 3 meetings ago, when we were talking about what we wanted to do in the future, one of the things you promised to do, Claire, was to look into asset managers to help provide us with direct lending opportunities, and somehow that seems to have gotten lost in the eddies as we move forward.
We said we would do that in the implementation phase, right? So step 1 is, do you want to add any new asset categories? And that was looking at private equity and infrastructure. We whittled it down to looking at infrastructure. And then Greg mentioned going through each asset class afterwards. Does your domestic equity portfolio look like what we want it to look like? International, real estate, fixed income. And part of that was the discussion of real estate debt. And that's going to decide, part of the question there is, does it fit into fixed income or does that fit into equity?
Still on track?
Yeah. So in our parlance, it's structure. So we decided asset allocation. We're looking at funding this new asset category infrastructure. And then we're going to look at the structure of each asset class. And when we look at those structures, we're going to go through and say, should we be doing something different in equity or bonds or real estate?
Huh.
And I think part of it was how much do you want in growth assets, and that partly determines if real estate, that debt fits into real estate or bonds, right? Okay, let's take a quick look at the individual manager performance on 34 and 35. And then we've got composite returns for each asset class, and we'll round out there. So on 34, page 34 captures all of your domestic equity managers. And one notable thing that we've seen that comes through on the page here that Greg already touched on is the reversal of growth and value, specifically within small cap. So small cap equity underperformed large cap. That's pretty notable here. For the last year, your small cap managers are negative, down 12% and 6%. Those are pretty negative returns for 1 year. Meanwhile, the large cap equity managers are up. The composite just about flat, positive 28 basis points, but the S&P 500 up just over 4%. So big difference between large cap and small cap. And then I mentioned the reversal of growth and value within small cap. Not quite so true within large and mid, but notably within small cap. So I'll start at the bottom of the page. Prudential small cap value and AB small cap growth. Small cap growth had a really challenging quarter, down over 7%. The last year, down 6%. Small cap value, positive 74 basis points, but for the last year, down 12%. So that was a strong reversal between those two managers too. Prudential is a manager that's a very deep value orientation to their strategy, and we've been looking to them to outperform when value comes back into favor. So certainly good to see that did happen. Just 1 quarter, so longer term performance remains underwhelming. below benchmark, and again, negative for the year. But when value yep, gotcha. When value came back, so did they. Let's see. Quick note on your large cap managers. Again, we don't have year to date on here, but both managers year to date up over 10%, 14% and 19%. Boston Partners Value underperformed for the year, but positive longer term. Harbor has done very well over longer term, even though disappointing for the year. So when we look at both these managers versus peers, though, they've done pretty well. They do okay versus active large cap value and large cap growth managers. Similar story for mid cap. I'll skip to international. This has been the asset category most challenged for this program. For the last year, a negative 3.5% return, underperforming the benchmark. This is a category that we will want to spend a lot of time on when we go through the structure review. Each of these managers acts very differently within the structure, and they do each play a different role, but it's continued to be a challenge over the last few years, so we want to take a deeper dive there. The one manager I'll mention here is Euro-Pacific Growth. I mention it because there is an update there to the strategy. So this portfolio is managed by about 7 different portfolio managers. Each of them manage a sleeve. They run their own portfolio, really, that aggregates up to the one. One of the portfolio managers, a fellow named Mark Denning, was let go from Capital Group. So Capital Group found out that he had been investing in a couple stocks that were in some of his portfolios and not reporting it to the company. That was a violation. And they let him go because of that. Those names were not in this fund, importantly, but they have replaced him as a portfolio manager. We're okay with the change, again, because there is no key person risk. There's a fair amount of diversification in terms of portfolio managers. But one thing we're going to watch there is whether that switch in portfolio manager changes the orientation of the strategy at all. So Mark Denning had a bit more of a core value tilt. The strategy overall is much more growth tilted. Again, it is within the portfolio, or the construct of your total international equity portfolio, so we're okay with it, but we wanted to alert you of that change. Fixed income and real estate remain pretty steady. Dodge & Cox and PIMCO remain good complements to each other, and you noted that they've done fairly well, almost a 10% return for the last year, and longer term returns together have continued to outperform the benchmark. The 2 real estate managers, Reef and Barings, again, both seeing much more of their return come from income than appreciation. That's a switch, especially for Reef. Reef is seeing about 2/3 of their 1-year return has come from income versus 1/3 from appreciation. That was swapped a couple years ago. It was 2/3 appreciation, 1/3 income. This is much more normalized. Barings has seen about 75% of their return come from income, 25% from appreciation. But no concerns with either of those managers. I ran through individual manager performance pretty quickly. Again, we're going to spend a lot more time on that in the coming year, looking at each category one by one, including real estate debt. The following pages have returns for each asset category versus the peer group, but I think all of that rolls up into the total fund performance that we've already discussed. In the interest of time, are there any questions? If not, I will skip going through those pages.
Okay. So next time you see us, we hope to be here with 2 infrastructure managers. If your schedule permits and we have the time, that'll be a good 2.5 to 3 hours with us. So we'll focus on learning more about infrastructure, deciding if we like those 2 managers, and then ideally decide whether or not we want to move forward for it. It doesn't have to be decided at the December meeting, but I think that's our overall objective for our next time meeting with you.
I have one question. I don't know how many of you saw last night Frontline's program in the age of AI.
No, didn't see it.
absolute must viewing. Must viewing. And the implications, it's, I think it's 2 hours long. It's a major production. But the implications, they talked about extensively in a couple of segments. And they're talking about, in some areas, 40–50% loss of jobs across the board. And the implications are just going to be humongous. And they're talking about this stuff within the next 5 to 10 years.
Yeah.
But these are kind of things we need to start looking over the horizon. And what I wonder is, are you talking with people who are looking over this horizon and seeing what these are changes that are not going to be, we go from cars and that's going to create, from horses to cars and that's going to create people making tires. This is not going to be like that.
Yeah, and to your point, I forget the statistic, but if you do a census and you say, what is your job? The #1 response for a male has something to do with driving a vehicle.
Yeah.
The #1 response is, am I a taxi driver, Uber driver? Do I
Truck
drive a truck? You know. And
Well, women in white collar jobs are going to be the hardest hit.
yeah,
Not blue collar jobs, but white collar jobs.
that's interesting. Yeah. Yeah. Okay.
But we need to.
On that
we need to
uplifting
be
note.
thinking. Well, we all need to be thinking about it.
Yeah.
If I may, to that point, the economist in me says, okay, there's going to be this massive change, reduction in the number of jobs. Economic resources will not sit idle forever. We will find some other use for those. I mean, the job of the economy is finding useful purposes for the resources. Something else is going to be done, or we'll move these resources from this thing they used to do to something else. So there's going to be growth opportunities in other areas because of that. I think that's the economist mindset of this, is we're going to take economic resources, human capital, from a relatively low value production and move it to somewhere else where it can have more value. It's not a painless process to go through. It's an incredibly painful process. But that eventually the economy will sort it out and we will adjust. As long as we're capitalistic.
That's a happy
free
word.
More
market society.
optimistic? Yeah.
It's going to be painful. It will absolutely be painful.
There's a lot of discussion about those things in this.
Yeah.
And we're talking about the next 5 years?
5 to 10 years. Yeah, huge changes.
Yeah.
Humongous changes. Anyway, please, all of you, to look it up on the YouTube or wherever you can watch it, because it is, I've been watching this for some time, and this program has just put a ribbon on the package.
Yeah. And Ray Dalio runs the biggest hedge fund in the world. He came out with a Daily Observer yesterday that says the economy is broken and it's not working and it's going to be fixed by one of a few different ways, and none of them are good. He was pretty pessimistic about and a lot of it comes to the income inequality.
Exactly,
Right.
and this
Comes to
gets
income inequality.
big into
What
that,
is
and
that?
how and why. It
I'll give
is
you a
just so
example.
enlightening.
So, thank you so much. Good to see
Thank
you.
you.
Very good.
Thank you.
Have a great meeting.
All right, see you guys.
All right, thanks.
Okay, how about a 5-minute break?
Okay, I won't pass up that.
Welcome.
Oh, thank you.
Thank you. You're going to give, Andy's going to give us a full report on an actuarial study.
That's right. That's what I would try to do. Good morning, Madam Chair and other members of the retirement board and the Young with Seagull Consulting. In front of you, actually 3 actuarial products. We rarely get to present 1 or 2, and this time we have 3 of those. The first item on the agenda, as you know, is on the funding valuation. So we're here to help you we are here to recommend to the board the contribution rate that comes out from the June 30, 2019 valuation, and there's a 12-month delay between the rate calculation and rate implementation. So if the board, once the board approves these contribution rates, they will become effective for 2020 and 2021. So it will be for the upcoming fiscal year. For those veteran members on the board, I hope that you actually have noticed and like the new format of the report. The one thing that Paul and I have difficulty, as an aside, we say that of course tongue in cheek, is that after having worked with the old report for 10 years, we really cannot read our own report unless we take off our glasses. So now we actually read our own report. So what I like to do is to virtually, basically walk you through primarily section 1 and section 2 of the report. There's a little bit of reorganization that have gone on in the new report. As it's going to be discussed in a new item coming up, there's a brand new section which we are required to put into the risk into the report for you. It's called a risk report, so we spend a fair amount of time going through that particular section. But otherwise, this is one of those reports. I'm now looking at section 1 of the report. I know most of you are working on your iPad, so I will just let you have a chance to flip to page 4. So this is section 1 under the funding valuation. It is on page 4 of our report. So this is very much a boilerplate. It talks about the purpose of the evaluation. Now, as Callan has briefed the board, you will be looking at, sounds like you will be looking at possibly changing your assets allocation and reminding the board that you have a policy actually to look at all the actuarial assumptions, in particular the investment return assumption every 3 years. So what would happen is that if the board decides to make a change in the assets allocation, my partner and I, my partner Paul Angela and I will be appearing in front of the board maybe at the end of the first quarter, the beginning of the second quarter of next year. So any decisions you make could potentially have an impact on the investment return assumption, 7% assumption. However, until you make that decision, we have continued to carry over unchanged the 7% and any other assumptions that the board approved like 2 years ago. So this is really a status quo valuation, so to speak, as far as actuarial assumptions are concerned. And then on page 5, we, again, repeating what I just told you already, which is we're here to help you set the contribution rates for the 2020-21 year. And of course, whenever we talk about contribution rates, we're not just referring to the employer, the county's rate, as well as the rates for the participating district and the court. We're also talking about the rates that our members will pay in the fund. Now, whenever we set the value contribution rate, there's always the question. So the plan has an unfunded liability. So what do we do with this unfunded liability? So we try to put that at the bottom of this page. The fact of the matter is, several years ago, we have worked with the board in deciding. Think of the unfunded liability as almost like a mortgage on our house that we need to pay. We know that we're going to live in the house. We don't have to pay the bank for all the money we owe them right away because we will continue to live in the house for many more years to come. So the question was, how long should it take for the mortgage to be paid off? So there was a decision made by the board to basically pay off the unfunded liability that was existing at that time over a period of 27 years. So right now in this valuation, there are 20 years left, and I will show you a schedule. However, the board decided that any new unfunded liability that you're going to add, that we would add for you as a result of actuarial experience or assumption changes, will be amortized over a much shorter period of 18 years. So think of this, I think Paul used this example in front of the board. So think of this as every so often you may have to decide to build a own bathroom in your new house. So you go to the bank and arrange for a mortgage. The bank asks you how long would you like to take to pay off the bathroom that you just add to the house. So the answer was, let's pay it off over 18 years. The 18 years was chosen to make sure that the first payment you make will allow you to at least pay the interest on the bathroom, on the mortgage. And that's unlike the original unfunded liability, which is pay off over a long period of 27 years with now 20 years left over. Because the attractiveness of a shorter amortization period is that even in the first year, you're paying off the interest. unlike a longer payment period, where the first payment may not be sufficient to pay the interest. So again, we call that negative amortization. I know that we're getting a little bit off topic on the funding policy, but that's important when you go through this report. So now, if I may ask you to turn over to page 6. And then this is the place where, again, I'm going to go through just a couple of items, 3 items with you. There's always a page reference, as you might have already noticed, on the left-hand margin. So anytime you're more interested in finding out after you go home today, for example, well, what actually has happened to the plans and funded liability, I want to find out a little bit more about that, you can always look at the page reference. First and foremost, in this valuation, we want to find out for you how much assets we have in the plan relative to the liability. So I'm looking at the first bullet point. So when we asked this question last year, the funded ratio, so-called funded ratio, which takes the assets divided by the liability, was about 70.4%. So think of this as for every dollar worth of liability, we had 70 cents was changed in the bank to cover that liability. The funded ratio in this valuation has gone up slightly to still about 70%. So again, if we ask the question today, we still have about 70 cents of assets to cover that liability. Now, the amount of the unfunded liability actually has gone up from about 212 million to 219 million. So you would remember I said, well, in spite of the fact that we have a payment plan in place to have the unfunded liability be paid for, then you could ask, so how come the amount of the unfunded liability actually has gone up between the last and the current valuation, and the amount of assets, we have the dollar example that I gave, so how come we still have about 70 cents of assets to cover that liability? So with that, maybe I would ask you to turn to page 29 of the report for me. So now I'm jumping to section 2 of the report. So I think from now on I will try to focus on section 2 instead of having you jump back and forth between section 1 and section 2. But do keep in mind that all the discussions that I'm going to have with you for the next 5-10 minutes, you can find in section 1 of the report. Now, this is on page 29 where we reconcile for you how the unfunded liability has changed from last year to this year. In line item 1 in particular, that was the amount of the unfunded liability of about $212.6 million last year. Now, if all the actuarial assumptions were to come true, the amount of the unfunded liability would be provided on line item 5, which is about $211 million. So the fact of the matter is, because we have a longer mortgage, for the initial amount of the unfunded liability, remember I said it was paid off over 27 years, and now we're down to the 20 years in the mortgage payment. So because the original mortgage was serviced over a longer period of time, so even if all the actuarial assumptions were to come through, the amount of principal that would be paid off by the county would be a little bit less so in the initial year. So as a result, the amount of the unfunded liability was only scheduled to go down to about $211 million. But then several things happened, as you can expect, during the year. So item 6 provide what those items are. Now, there's always a question as to, and I think you have already heard Callan when they were here to provide you with the rate of return. And now I should have mentioned from the get-go is that whenever we talk about the results of the valuation, it is done as of a snapshot date. And the snapshot date we have used for this valuation was as of June 30, 2019. So this means that any changes in the value of the assets since July 1 of 2019 up through September of this year, and more, maybe even more importantly, until the fiscal year begins July 1 of 2020, none of that have been taken into account. So then you would say, okay, well, why are we falling behind? Because it takes a certain amount of time for us to get the financial information from your investment bankers, get the membership data from James and his group. So therefore, we have a kind of lag building process. But in any event, this valuation captures the financial results up through June 30, 2019. There's a page in our report where we talk about what the rate of return was, and I think this would not be a secret to you and not a surprise to you. We expect the fund to earn an assumed rate of 7%, at least in the very long term. Over the past 10 years, I think we have met and exceeded the 7% assumed rate of return assumption. Yes.
I have a question about 6B, about the salary increases. And I know that for several years, if you're smoothing that number, that we didn't get substantial increases when all of a sudden, and I don't know if you're factoring in July 1st and onward, is not included in this formula.
Correct.
Calculation.
So but Madam Chair, your point is well taken, because I still remember the year when Paul and I came over to present to the board right after the market crisis in 2008, 2009. The same question came up, so Mr. Actuary, why would you even think that our members, the county would grant our members the salary increases that you expect to see in the long term? Because for several years since 2008, this item 6B, for example, has showed up as negative. Negative meaning that our assumptions are way too conservative, are too high. So this is actually the exact opposite happen, because what we like to do in evaluation is to project for the very long term period. So believe it or not, when we ask the question, how long are the assumptions good for? So we would have to say that for our retirees, for example, how long we expect our retirees to live, we have to answer the question by saying that, well, our retirees may be average age 60, so we expect them to live a good 30, 40 years. However, we have some active members that we have to apply the mortality assumptions. So some of the active members might be just higher in the 20s, so they might work for the county for a long, productive 40-year career before they even retire. So the assumptions have to be in place and good for a period of sometimes up to 80 and 90 years. So these are very long-term assumptions. So what we can tell you, we assure you, is that they're not always going to come true every year. So some years are going to be too high, some years are going to be too low. So this, especially on item 6, is the year where looks like the county is granting the salary increases for active members. So the assumption a little bit at least our assumptions are a little bit too low. But we always like to encourage the board, especially the other stakeholders, to look at very long term. That's the only reason why we set these assumptions, and one of the objectives is that they are good for the long term, especially on things like the salary increase assumption. Yeah. Now, I think going back to item 6A, the investment return assumption kind of works the same way. So some years they would come in too high, some years they would come in too low. Now, as a matter of fact, for investment return, because we know that they are so volatile, so you could be looking at the investment return assumption every day, and you can change from the beginning of the morning, the beginning of the trading day, to the end of the trading day. So what we try to do is, especially for the investment return assumption, is to not just look at the rate of return for the last year, but rather we will spread it out, smooth it out over a period of 5 years. So it's important for me to point out that the investment return less than expected, this is over a 5-year period. So otherwise, if we have used market value rate of return to set this investment gain and loss item, it would be much greater. So bottom line is we are here for the long term, so that's why we're comfortable in using a smoothing methodology. So it's also worth pointing out, because Madam Chair, you pointed out that we always like to look at this at the long term. So if you have last year's report at home, do take a look at the investment item, because last year, this item on investment actually served to reduce the unfunded liability by about $6 million. So last year, we did very well, even after only taking into account some of the investment gains, but we were able to reduce the unfunded liability by over $6 million last year. This year, it's the exact opposite. So we have to give back about $5 million this year. So we expect that this number to continue to jump up and down each and every year. So that's why we have to do the valuation every year, because otherwise we will be dealing with old data, and especially financial data, which we know can change very rapidly. So other than that, there's always some investment gains and losses, miscellaneous actuarial gains and losses that will come into play. And so this year it helps us. So now looking at item 6D, because it reduced the unfunded liability by about 1.3 million. So if we look at all the items in totality, it adds to the unfunded liability by about $8 million. So if I was stopped by on the street by one of the members and say, hey, what's gone on to the valuation? Why is our unfunded liability going up this year? I would say 2 reasons, kind of split evenly between investment experience. After smoothing, we have a bad year, no way to sugarcoat that, plus that there was a salary increase high expected given to our members. So those really are the 2 reasons why there's an increase in the unfunded liability.
I have a question related to the same topic Madam Chair brought up about the individual salary increases. This is as of June 30th, 2019, and I think most of the people at the table know that a lot of bargaining units were at negotiations at that time, and many of them have agreed to very significant raises for upcoming 2 to 3 year periods. And that is in no way included in this report, correct? Because it was after the June 30th cutoff.
That's right.
So we can expect that 6B section to probably go up in future years here because of the higher than expected raises for employees in maybe next year's evaluation as well.
That's right. And
Okay.
so there's, I think, some limitation to our reporting
Yeah.
because we always like to have the data reflect the actual salary increases
Yeah.
that our members receive before they reflect in the valuation. So you're quite right that if it is a 3-year cycle and some of the salary increases may not have fully kick in, then that would appear in the next valuation. On the other hand, in the valuation, because we look at the salary increases for the very long term, so built into the assumptions, for example, would be on the average that our members would get a across the board inflation adjustment in total of about 3.5%. So the question is, in those agreements that have been reached between the bargaining parties and the county, were there increases in the very long term over or under the 3.5%?
A lot of the ones currently they're calling survey adjustments essentially to the market adjustments of what we are compared to other counties. So some of them are upwards of 30 or 40% over 3 years.
I see.
And that's what I'm concerned about because it's not reflected in this, nor could it be reflected in this because it all happened after the timestamp of June 30th. And that's going to be a significant impact on our system.
Yeah, I know that before the presentation, I was talking to Dr. James Wilbank about what happened to our deferred vested members. Not particularly on point, but we know that we have a lot of deferred members. After they left employment at the county, a lot of them usually go to, for example, a neighbor sister county over at Sonoma. So the question is it reasonable for us to expect that even though they're reciprocal counties to Mendocino, do we expect that they would just be getting the same type of salary increases that our members would have gotten? So I know that we're going to be doing a survey of increases that actually took place after they left our systems and go to Sonoma. So maybe what we can do is, again, this is not our practice to reflect the upcoming salary increases, but we can certainly work with Dr. Wilbank and his crew to try to figure out if there's any justification or any reasons why we may want to at least be informed of what those salary increases are so that we can take that into account, because we have an experience study actually coming up in the second quarter of next year. So in the experience study, what happened is we don't leave the actuarial assumptions unchanged for a very long period of time. As a matter of fact, we look at every assumption, including the salary increase assumption, every 3 years. So next year would be the typical 3-year cycle. So we can certainly work with Dr. Wilbank and try to figure out if there's anything that we can do to take those into account.
And not to stay longer on this topic, but my personal concern is that these are, especially in my time with the county, the most significant raises most employees that currently work for the county have seen, ever.
Yeah.
So I don't think there's any way for us, as of this date of the report, to reflect that.
Yeah.
But they are very, very significant raises over a 3-year period.
Certainly. Now, this could be a good segue, perhaps, to our upcoming attraction, the risk report, because one of the key reasons why we think that it would be a good idea for the board to look at the risk report would be, granted that when we do evaluation, we have to make the assumption that everything would come true, that all the actuarial experience of the plan would match those assumptions. So the question is, well, what if salaries for our active members are going to take a number of years? So every member would get a salary adjustment of 20%. So how is that going to impact the county's budget for the upcoming year? So those would be the type of analyses that we can actually put into a risk report with the end outcome that even before I appear in front of this board in November of next year, we will be able to send that report over to the county so that the decision makers, the stakeholders at the county would be able to better budget for possible times ahead of them. So in this case, it might be a huge increase in contribution rate, and so at what percentage payroll.
The other factor that's going on here with the salary increases that significantly impacts what we'll be looking at in the experience study is there's some at the county are expecting there to be significant salary adjustments, but reductions in headcount. And what I've always explained to people is what we look at is total payroll. We don't care if you pay half as many people twice as much, as long as the payroll growth is meeting our assumption over the long run. So that's another factor that we'll have to include in here is the potential expectation that there's going to be higher salaries but fewer headcount. And we'll have to think through how all that plays in. Am I off base when I say we care about total payroll and that our assumption is applying to total payroll over time?
I think in this case, actually both are equally important because, James, you're right that when we have an unfunded liability in the plan that we do, we have to pay it off and it is spread as a percentage of payroll. So to the extent that the payroll base is continuing to grow at 3.5%, either through hiring more people or maybe shrinking the workforce, but still giving the ongoing active more money, that's fine. On the other hand, so that's on the contribution rate calculation. On the other hand, the liabilities of the plan are determined on an individual by individual basis. So to the extent that for each and every one of our active members, if their salaries are actually going up much faster than expected, actually the amount of the unfunded liability will go up by itself. So they are very important, equally important, and we will need to see exactly how do they play into each other, and it's something that we can certainly model as part of, for example, in the risk report and risk analysis.
Okay.
Wouldn't you refine that a little bit, that you'd be more interested in raises given to PEPRA, non-PEPRA, than just the total because of different benefit levels of the two groups? Could I ask,
Yes.
before we get too far out, could you explain what number 3?
Yes. Experience fee?
About a joint annuity and single life annuities? I don't understand.
What page are you on?
29.
Oh, yeah.
Footnote number
Oh, footnote
3
3.
has to do with refinement of the pension goal to change some annuities from joint to a survivor annuity. I'm not sure I'm following that.
Yeah, so that's Tim, based on the refinement in the data that was reported to us. So in the valuation, as you're aware, for our members who are married or maybe with a domestic partner, they would be entitled to an automatic 60% continuance benefit that would be continuing to the spouse or domestic partner. So the question is, where did we get the data as to whether or not someone is married or with a domestic partner? And in this case, in this year, there was a refinement in the process that was utilized by the staff at the association to grab the data and report it to us. So, yeah.
Is this because you're going through all?
It's LRS and Pension Gold has created more reporting capabilities for us in the data that we extract and report to the actuary. So that's really the driver there.
So it's reducing the unfunded liability, so evidently you're finding that fewer people are going to have a continuation, is that?
Yes, yeah. Or we're actually able to communicate to Siegel, the extract now tells Siegel, this person is an unmodified, but there's no continuance expected here.
Okay.
The other thing I wanted to add too is that in past years, the actuarial accrued liability included a higher annual increase in income, far higher than what employees actually got. So it's not that, even taking into consideration that we got a huge raise as of July 1st, the other prior years, there often we didn't, but yet the actuarial study reflected that we did get a bigger increase. I'm sorry.
Oh, no problem. Yeah, and just back to that point too, was the CEO's office, did they work with the actuary at all? Are they required to do that during this raise process, or were they not?
Oh, interesting.
I was just curious.
Andy, correct me if I'm wrong here, but I'll jump in here and say, my understanding is the CEO's office did contact Siegel and I examine the possibility of getting an analysis done before any raises were approved. And the CEO's office determined that doing that was not a legal requirement. And they elected to not get an analysis done of any raises by Siegel. I believe they may have some other tools they're attempting to use to try to understand things, but they've not had anything done by Siegel.
That's used to be a requirement in the 37 Act.
I think my understanding, not being a lawyer, is that what's required in the 37 Act is that if there is a change in benefits, that has to have an actuarial analysis done. But the CEO's office has their own legal counsel, and they worked with their legal counsel, and they've done what they feel they need to do.
Yeah, I thought it was mentioned somewhere, but I couldn't remember exactly what was said there, so.
So just in the discussion of the employees haven't had a raise for many, many years, probably 10 years or so, plus a take back and then a slow regain until this new market study. This amount we have actually recognizes those events because they're in the past.
Right.
And so I think we're still, like, back to what I think Quincy's concern and mine as well, is that the current contracts are not factored in here. And this is such a delay to 2020 that, and not before we have any idea what the impact is to the unfunded liability. So I hear also that there's some positions that maybe won't be filled and that'll be cut, and that's the makeup for this gain. But historically, those positions that were cut were unfilled and even unfunded. So if we're talking a percentage of payroll, that's actual payroll, I imagine, and not including unfunded payroll. And that is where the cuts happened before, in positions that were unfunded or vacant for a long period of time, not really cuts to actual jobs. So I think it's just putting back, I think Quincy's concern too. I echo what this means to the unfunded liability going forward. And I don't know, I wish we had more information. I know there's a timeline cutoff, but very concerned about the 3-year implications and the market adjustment, and our cost of living was 3% per year. So if we're at 3.5, we're only off there by 0.5, not factoring the market adjustments. So I think it's going to have long-term, large implications to the unfunded liability.
I think in cases like this, what we have seen done in other retirement systems is that in addition to, for example, if and when and after the board approves a contribution rate, I think it's not unreasonable for the board, for example, to add on and just making a suggestion, a piece of communication from your administrator, for example, send it over to the county to remind them that none of the more recent salary increases have been included by the actuary in the valuation, because there's always some limitations as to what you can or cannot reflect in the valuation. So that way it would serve the county as a reminder that when they do their budgeting, not for the 2020-21 fiscal year, but for the upcoming fiscal years, that they take that into account. That might be a good idea. Yeah, so that's, again, very healthy discussions on the unfunded liability. Now I may just ask you to turn over to page 31, and then I'll try to jump into back and forth in different sections of the report. Because on page 31 is really what happened to not to the unfunded liability, but what happened to the contribution rate for the year. These items, again, I'm not going to read this off to you, but they are very similar to the items that we have seen a couple of minutes ago when we were trying to reconcile the change in the UAL amount, because after all, anytime there's an increase in the unfunded liability because investment experience was poor, that would prompted a contribution rate increase. I think the only item on this page, which you don't see on the other page, has to do with the effect of amortizing the prior year's UAL over a larger than expected total payroll base. So I think this gets to the point of Dr. Wilbank, which has to do with the fact that in the valuation, we spread the cost to pay off the unfunded liability as a percentage of payroll, assuming payroll will grow at the rate of 3.5% each year. So good news is, because our active members are actually getting the salary increases, if you look at the payroll base, for the positions actually better filled. So in the valuation, we only look at the bodies, all the members who have a salary earned during the year. So if we look at just those salaries for those positions that have been filled, it's actually greater than the 3.5%. So in this case, it's a small positive impact on the employer's contribution rate because it served to reduce the rate by about 0.26% of payroll. But after all, everything is said and done, if you look at the change in the contribution rate from last year to this year, it is going up by about 0.4% of payroll. Again, I encourage you to take a look at the valuation report from last year once you get back to your desk or your office or home, because last year, kind of coincidentally, the reduction in the rate was about 0.4%. So I just want to highlight this for you because there's always going to be some ups and downs in the contribution rate setting, and it works out quite nicely. If we look at the contribution rate, not for a prolonged period of time, but just for 2 years, last year it was a reduction in the rate by about 0.5% of payroll. This year is an increase in the rate by about 0.5% of payroll. So I'm not suggesting you do that, but if let's say we skip over last year's valuation and you look at between the two valuations and you say, okay, well, they actually fell asleep at the wheel because the rates have kind of unchanged between the two valuations. So it kind of works out the way we expect it to, because some years we expect the rate to be favorable, it goes down. Some years we expect the rate to be unfavorable, it goes up. So this is actually happening if we look at the last 2 years. So that's on the employer's contribution rate. So if we look on page 32, it's a lot less eventful for the members' rate because for the system as a whole, the members' rate have basically remained almost unchanged. So last year was about 9.49% of pay, and because there's some change in the members' demographics that goes to what are the types of members that are covered by the plan. Are they younger or older when they enter service at the county or the district? So in this case, it's a slight favorable impact on the rate, but nonetheless very little change. Now, the board may ask, okay, well, you've talked about changes in the employer's rate because of investment experience, salary experience, and other actuarial experience gain and loss that we did not identify. So how come we did not see the same kind of event on the members' rate? So in this case, I want to remind the board that unlike the employer's rate, the members' rate are set all based on actuarial assumptions. So in other words, when the times are tough, when investment returns did not come in as favorable as what we expect at 7%, the members don't get to pay for those actuarial experience. So likewise, if you go back to last year's valuation report, when the investment experience was better than expected, there was no reduction in the members' contribution rate either. So again, members typically don't share in any good, for that matter, bad actuarial experience. However, we want the assumptions to be realistic. So if we were to, let's say, recommend a change in the assumption next year, which would be more conservative, we tighten up the rate, the members would have to pay a part of that as well. So anytime we change the assumptions, the members will feel the impact. However, if we don't change the assumptions, the members won't feel the impact right away. So that's noteworthy. So then I think what I would like to do now is to turn back, and it's still staying on page in section 2. But I'd like to just walk through, if I may ask you to turn to page 20. So just show you how remember I said early on, we don't use market value of assets in the valuation, but rather we use the smooth value of assets. It's called the actuarial value of assets in the valuation. So this actually chart shows you how the investment experience gain and loss fared up over a period of 5 years. So, for example, I'm now looking at line item 2E. Last year, for June 30, 2019, the actual return for the fund was about $19.9 million. We expect the fund to earn 36 million, and so as a result, there was a shortfall relative to the investment expectation, and so the loss of 16 million. Now, here again is where you actually will look at the investment performance somewhat differently from what Calum would be tasked to do, because, for example, during the course of 2019, when Calum come to you and say, well, guess what, the board, we have been able to, in spite of the difficult time that every pension system has to face, we have been able to turn a positive income of $19 billion. So that's actually a good news day, because we earn more than zero, right, in that case. However, the actuary will look at it slightly differently, because in the valuation, we have been discounting the liabilities, those payments that don't have to be made by the trust fund like right away in the upcoming year and maybe in each of the next several years at the assumed rate of 7%. So there's an assumption implicit in the discounting of the cash flow that you have to meet or make a 7% return to basically break even. So that break even investment return expressed in dollar amount was 36 million. So whereas when Calum came in and reported to you, in spite of the tough times that every pension plan has in the nation, they have been able to generate a positive return of 19 million. But when you hear from the actuary who say, well, 19 million is great, but it's not the best. As a matter of fact, we expect we need the fund to have earned 36 million. So as a result of this 1 year, we failed to meet the assumed rate of return assumption by 16 million. And what we do is to spread and smooth it out over a period of 5 years. So that's why there's an 80% factor for an underlying item 2E. So we are deferring, for recognition purposes, 80% of those losses. So we're deferring about $12 million. However, if you ask me what happened in the year before, because Calum told us that year 2018 was a great year. So what did you do, Mr. Actuary, for the return? Same thing. When we have great returns, such as what we have in year 2018, we earned about 45 million, when in fact we expect the fund to earn only 33. So we defer a substantial portion of the $11 million. So we were deferring 60% of those investment gains, with the end outcome that we still have $7 million that we have not yet recognized. So it is very important, because if you take a look at the score for all the deferred gains and losses, for this valuation, the amount of gains and losses that we have not recognized is a very small gain of $35,000. So that's in line item 2F. So then you may ask, so what happened to the gains for year prior to 2018, right? Because it looks like we have 2 or maybe 3 of those years were very good years. So the fact of the matter is, if you look back at this year, at the report last year, we were deferring a substantial amount of gains. So how fortunate we are actually deferred the gain, because had it not been the case, we would have to come to the board with an even worse news, which is the contribution rate will have to go up even further. So this, again, is smooth value of assets working for the board to give us a little bit of bad news is supposed to a big dose of bad news when times are tough, and it can work the other way. So now, this actually is another recommendation that we have in the front of the report, because when you look at the 35,000 in net deferred gain, and if you ask Siegel, how much of these gains and losses are you going to recognize in the next several valuations? So now I would refer you to the very small print still, item number 1 footnote. Because in spite of having a gain of 35,000, if you ask Siegel, if we let the smoothing methodology go unchecked, next year we will be recognizing a loss of $2 million. And then you will say, well, wait a second, the math must be wrong. And the reason why this happens to be that way is we have a schedule up front in the top where we recognize the gains and losses 20% at the time. So it really depends on how much loss are we recognizing next year versus the gain. So with the way the math works out is, to answer the question of in order to defer a gain of $35,000, how much are we recognizing? It would be, the right answer would be a loss of $2 million, which mathematically would not make a whole lot of sense. So for that reason, there's a particular provision in your funding policy which actually anticipates when the markets are irregular, when they are giving us somewhat irregular gains and losses, this could happen, and we anticipate that as part of the funding policy. So one of the recommendations in this year's report is to go ahead for the board to consider going ahead, take the $35,000, actually recognize that 1/4 over the next 4 years. So it would be just a gain of $9,000. So I think that would allow the board to provide a much smoother contribution rate in the rate setting process for the next valuation and for the 3 valuations to come. So that is, again, one of the recommendations that we have in the report, is to kind of smooth out the $35,000 and not have that be heavily influenced by the pattern of gains and losses.
So that's the recommendation on the bottom of page 7, I believe, where it's prior board activities would say to smooth that out over $8,848 over the next 4 years instead of the volatility that you just mentioned on
That's
that
right.
page.
That's
That's
right.
much more
Exactly.
extreme.
Exactly.
Okay.
That's right. So that's right.
And Andy, I think board direction would be sufficient in this case. So having just gone through that, I think we should stop there and see if there's any questions on that and maybe get board direction. Is there board direction to do so?
Sure, but it doesn't seem like it's that much money.
So material.
Yeah,
I mean, in aggregate, it's small,
yeah.
but you're talking about a $2 million loss one
Yeah.
year, a $6 million gain the following
Yeah,
year.
each year.
Why not just level it all out?
For discussion purposes, when I saw item 8 on page 20, I was confused a little bit as to why we would do that. I understand it fits with the model for the valuation, but the $8,848 over a 4-year period makes more sense to me personally. And it's less volatile, which this, the $2 million loss, then a $6 million gain, and a $900,000 loss the 3rd year, and then a $3.2 million loss, all for $35,000 seems, excessive activity for me.
At the end of the day, it does not matter to us. It is a benefit only to the plan sponsors because they can have less volatility in future years than what we would expect if we continued with the existing 5-year schedule. There's no downside to us, there's no upside to us. We can reduce the contribution volatility to the plan sponsors by adopting this aggregate 4-year layer of the deferred investment experience. And I would recommend we do it.
Considering the unknown for the salary increases, I think we should do it to minimize the plan sponsors' volatility.
Yeah, for the first year, but the second year, we'd get a $6 million
Yeah.
increase, which would make a nice timing.
True.
Yeah. I don't, it's fine, I'm fine with it.
So directed.
Okay, thank you. All right.
Okay.
So I think with that, I'm ready to walk the board through a brand new section of our valuation report. So it is provided on page 41, so still under section 2. I think this, again, by way of background, this is a brand new so-called ASOP, stands for Actuarial Standards of Practice. So for actuaries like Paul Mendel and myself, in order for us to be able to sign the valuation report, we have to include a brand new section talking about the risk. I think rightly so, every time when we present the valuation, I think you have heard me say so a few times already. I lost count how many times I said that, but the reality is whenever we put a valuation report in front of the board, we always have to disclose, caveat that by saying that, well, if all the actuarial assumptions were to come true, here's what the contribution rate requirements would be. But I said already that the assumptions rarely come true. Some years it would be higher, some years it would be lower. So again, the spirit of the new risk ASOP, the actuarial standard of practice, is to let all the stakeholders know that the evaluation is predicated on a fixed set of actuarial assumptions. We assume that for the next 90 years, the plan is going to earn 7%, so which we can almost tell you today is not going to happen. Some years it's going to be higher, some years it's going to be lower. So in the risk section, we're supposed to highlight for the stakeholders of the board what happens if something goes the other way. Now, usually, if there's a favorable event, so let's say the active members don't get the salary increases in the valuation, and we all know what would happen, the contribution rate will go down. So there's really nothing that you need to do to prepare or plan for the contribution rate going down. But we are more concerned with the downside. What happens if salary increases are coming in higher than expected? So we have already given some examples as to why the risk report might be a good thing to do. We have also spent a lot of time, rightly so, talking about what happens if the fund earn less than the assumed rate. So in this particular section of the report, we have already highlighted for you without even going through and picking up the projection models that we have done in 2018. We have been able to provide to you on a very rough justice basis what happens if the fund earn a return which is 1% lower than what we expect to do. So we think that we are in compliance, we are in compliance with the risk ASOP if we just put this section in the report. Again, I'm not going to read over everything to you, but do pay a lot of attention to what happens if the fund earn less than the assumed rate. So I think that would be the thing that I want to highlight for you. And I think with that, we can, I can ask to see if the board has any questions, and because I know that we have the same item coming up on the risk report. What if you decide to do a standalone risk report?
I think it was very clear. I don't have any questions.
So I think, Madam Chair, with this report, we are providing you, the board, with the recommended contribution rate for the employer and the employees for the 2020 and 2021 fiscal year.
Okay,
Will you adopt it?
I think a motion to adopt would be appropriate.
I move to adopt.
A second?
okay, any discussion in the motion? No discussion? All those in favor?
Aye.
Opposed? Abstain? Motion passes.
Right. Agenda item 5, I believe.
Yeah, the GAS 67 actuarial valuation discussion and possible action.
Yeah, so thank you, Madam Chair, and other members of the board. So my presentation for this item actually is going to be very brief. So what we have done is to take the same membership data, take the same assets. So although in this case, we are required by the governmental accounting standards board's requirement, the GASB, to use market value of assets. So everything I said early on about having a smooth return, smooth unfunded liability, all that is prohibited under the GASB rules. So we have no choice but to use the market value of assets. So if you look at this valuation, compare that to the unfunded liability that we have included in the funding valuation but determined on a market value basis, they're very close. The funding methodology is slightly different, but nonetheless, it is a market value assets valuation, and there's no flexibility. So I think with that, I'll just ask for any questions or comments.
So, do we need to have further discussion? I guess not, I
Is there
guess.
any action required?
I don't think receiving the report. Just receiving it. I don't think there's any action required here.
We understand and, okay,
Very good.
Thank you.
all right. Thank you very much.
We got one more.
We have,
Item number 6.
okay. Okay, on number 51, assessment and disclosure of risk associated with measuring pension obligations and determining pension plan contributions.
Okay, thank you, Madam Chair. Sure, James, you want me to?
Yeah.
Okay,
Yeah.
so we have a PowerPoint presentation that we put together, together with 2 sample reports that we've been providing to some of our other 37 Act Retirement System clients. I've already talked about why the board may want to consider a risk report. So as a matter of fact, several years ago, I think it was in the year 2018, the board has similar concerns. So the question that was raised back in 2018 was, well, Mr. Actuary, you have been assuming the fund would earn an assumed rate of 7%. So what if we have a prolonged down market cycle? So what could potentially happen to our contribution rate, to our unfunded liability, as well as to our UAAL amount? So we did a projection for the board as a result of that discussion. So I think in front of you is a possible enhancement to the section that we have in our risk report to include not just the material that you have already seen, but also include, for example, on page, looking at slide number 6. So, so the question that we have been asked and answered for a couple of our 37 Net County clients that who have decided to commission SACRS to do the standalone risk report is to basically dissect for them why the unfunded liability has done nothing but grow and grow for that particular system. Now, I don't expect the answer to be materially different if, quite candidly, if I were to do this analysis for you. It is important to get a sense of direction. So, for example, in this particular system, when we did the analysis over a period of 10 years and see why the UAEL has gone up, it was really through actions that were taken by the Board of Retirement at the recommendation of the actuary SACRS. Because every time, so this is the no good deeds go unpunished concept, every time we come in and recommend to you that let's reduce or let's tighten up the investment return assumption, the first thing the actuary will do is to measure the liability, those benefit payments that really has not changed at all because I'm retired and entitled to the same benefit payment they're entitled to. But what we would do is, when we discount those benefit payments using a now a lower discount rate, the liabilities may appear to be bigger. And the reason why this is the case is going back to the question that was discussed with your investment consultant is, every time when you discount the same cash flow at a lower rate, it will increase the liability. So for this system in particular, and I don't expect the scenario to be very different for MSARA, is we will be increasing the liability. So as a matter of fact, for this client, over the course of 10 years, we have remeasured the liability 3 times. So as a result, we can almost tell that the reason why there's an increase in the liability for the client and UAEL is because of the change in those assumptions. Now there's a companion chart on 7, basically the same thing. So if the news was that whenever we remeasure the liability, we increase the liability by say 50% over the course of 10 years over 3 experience study, what has happened to our UAEL contribution rate? Same kind of a scenario. You would only expect the UAEL rate for the system to go up. And again, I don't expect to have to go through the analysis to be able to prove that to the MSARA board. But then the board may say, okay, well, there's going to be a certain amount of expenses, right, associated with doing this report. So tell me at least one reason why the board may want to expense dollars to doing this study. Now, I think we are actually one of the very few systems where you actually invite the actuary to present the valuation report to the Board of Supervisors. So you may be aware that you are very unique, and I think we embrace that concept because it's very important for the board as well as the other principal stakeholders in the county to know what's going on. I think one question rightly so has come up at the Board of Supervisors every year. So like clockwork, 5 minutes after the beginning of the meeting, I got that question, and James would be there to answer the question is, well, how come in spite of us putting contributions in, how come in spite of us following your actuary's recommendation in using those assumptions to value the liability, how come the UAL has keep coming up and over and over and over again? I think it is very important for us to at least answer the question in a systemic fashion by showing them this report. This is really what happened. We're managing the increase in unfunded liability, but unfortunately, with the way the math works out, is that every time we remeasure the liability using a more conservative assumption, it is going to increase the contribution rate. So now the Board of Supervisors, maybe the Board of, more importantly, Board of Retirement accept that. Then the question is, well, what will happen? Exactly at what point in time will the unfunded liability be paid off? So we trust you, Mr. Actuary, that the unfunded liability will be paid off, but can you demonstrate to me that it will be paid off? Now this is actually a question that was answered several years ago. I'm now turning to slide number 10. So on slide number 10, we look at the UAAL and the associated funded ratio. So this was back in 2018 when you asked us under several scenarios, what happened if future will continue to be as bad as what we have experienced in the last 10 years? Now, in spite of those very pessimistic scenarios, under the board's funding policy, we have a commitment to have the UAAL be paid off over a period of 18 years. So in spite of some of the scenarios, which I'm not going to read it off over to you, the UAAL will be paid off, even under those, I would say, doomsday scenario. Now, granted that, the full disclosure, of course, if you look at slide number 11, the employer's rate will have to be increased dramatically if we don't meet the assumed rate of return year after year. But at least there's an end game The end game is that at the end of 18 years after that unfavorable event, the employer's UAL would be all paid off, the employer's UAL rate would be reduced down to 0. We think that in addition to answering that question, there might be some utility because I know that the employer, they already been starting their projection for the upcoming fiscal year because they don't want to wait for the actuary to come out with the 2020 valuation report. And if they were listening in, for example, over the internet to Callan's presentation, they've heard that, well, it looks like the first 3 months of the year, the rate of return came in maybe roughly about 0, so which is less than 1/4 of our 7% return assumption. So how is that going to mean to our contribution rate? They would be able to take a look at the contribution rates such as those that we have on page 11, kind of interpolate between those amounts and be able to get a very good estimate for budgeting purposes anyway of what the contribution rate requirement would be. So I think if the board were to be interested in having a standalone risk report, we would certainly be more than happy to work with Dr. Wilbank in trying to find out exactly what are the scenarios that might be of interest. I think we have already heard investment return, and more importantly, the salary increase as another one. So I think those are the kind of analyses that we can put into a risk report that can be produced in time and even before the next fiscal year is going to begin. So that way we'll give all the stakeholders plenty of time to plan ahead before the June 30, 2020 evaluation. So I think that would only leave us with, well, whenever we do the projection, you still have to pick the scenarios. So there's another school of thought that we said, well, rather than to dictate the scenario to SACRS, why don't we go through a so-called stochastic modeling, so which is on page slide number 14. So this is really where we kind of roll the dice on the investment return assumption and answer that question on the probabilistic basis. So again, this would be something that we can certainly work with Dr. Wilbank once you decide that that's something that you want to do. I think at the end of the day, when we go to slide number 20, even if the board decides that you like the risk report, you like the ability to communicate to the other stakeholders at the county, for example, what could happen if some of the assumptions were not to come true. The reality is you don't have to do this analysis every year. I think you can do that every so often, every 3 years, for example. You can do that maybe before the experience day or after the experience day, whichever time you think that might be most appropriate for the board so that you can provide all the other stakeholders with as much information as possible. So I think with that, I'll just...
So you would use June 30th of 2019, you would take a projection into what the next year or two, I mean, because I think, yeah, in light of what everybody's talking about, I think the timing on this is pretty good. What is the cost?
If we do the historical look back at why the UAL rate has gone up, so plus the deterministic projection, the more simple model, we would expect the cost to be about $10,000 to $20,000. There's a significant amount of setup cost this year, because what happened is if we decided, okay, well, I want to institutionalize this and have that be an annual process, next year there would be no setup cost, so it would be only the projection, in which case going forward we would only be talking about $10,000. So first year is higher because we have to look back at the history, so it's $10,000 to $20,000, but going forward it will be just $10,000 if we decide to do the more deterministic type of projection.
So, if I may, Madam Chair, to summarize, the board has two options to satisfy the ASOP requirements. You can either have a qualitative report included in the annual valuation study, which is the new section, that Section J, or Schedule J in Section 2, whatever it is, that Andy referenced, and that satisfies the ASOP requirements. If the board wants to go further, we can do a standalone report, and then within the standalone report, we can either do a deterministic modeling, similar to what we did with our letter in 2018, or we can do the stochastic modeling. So I think the first question is, does the board see interest in doing a standalone report? And I would lean toward, having essentially asked the question in 2018 and gathered the information, that to me is an indication that the board sees value in getting additional information besides just the words on the paper. So it would be my recommendation that the board take on the additional cost and do a standalone risk report. That's kind of the first question. Is there?
Do we want to do a motion on that?
I don't think we need a motion
Okay.
on yet.
Okay.
So I'm just trying to walk us through the decision matrix. So the board, I'm not hearing any significant, absolutely not, we're not going to do a standalone risk report. Then the question is, do you like the deterministic or the stochastic? Andy, you said the cost first time on deterministic is 10 to 20,000.
Correct.
And that's on the deterministic. On the stochastic, it would be,
An additional $10,000.
Okay.
Additional $10,000.
so 20 to 30,000 to set up the stochastic.
Right.
Okay. And that's a one-time setup fee the first time we do the study. After that, what's the ongoing fee?
Yeah, so I would say after that, if you decide to just do the deterministic, it would be $10,000.
Okay.
And then even if you do the stochastic, I think it would be coming very close to 10,000. So maybe slightly more, but not much more, because the significant amount of work is done in researching the history and setting things up for the future.
So stochastic meaning random
Yes.
scenarios,
It's-
implications of if you do this, then this will happen.
Yeah, what you get is the probability distribution, like Andy showed on page 15. That shows you the 25th percentile versus the 75th and those kinds of things. Versus, assume we get a 0% return this year and then 7% afterwards. When we're doing the stochastic, our investment return is, we expect it to average 7, but it's going to vary around that very markedly, and they will run what are called Monte Carlo simulations, where you pull out a number every year based on the distribution that we design. So the stochastic gives you, in my opinion, gives you a lot more information. That's the direction I would lean, but I don't have a vote.
You would lead to just do I can't say the word.
Stochastic? Yes.
Just that and not the,
Not
Yes,
deterministic.
right.
It's my understanding you have to do the deterministic to get the stochastic.
Exactly.
So you have, it's all or nothing.
At least
If
the
you're going
first year.
stochastic, you gotta do the initial two.
Yeah, because
So-
yeah.
Because you need the baseline, or you need the.
Exactly, yeah, and I think, for example, to answer the question which, right, so has been asked, what happened when the higher salary comes into the data? I think we can only answer the question, that one, I think we can answer very comfortably with the deterministic, because the bargaining agreements will show us is at 10% or 20%, so we don't really have to model that in a stochastic manner. But I think we would recommend in this case, if that's the scenario you want us to test, is go ahead and order both, and we can model the salary increase deterministically. But as far as the market rate of return is concerned, we certainly see the same value that Dr. Wilbank referred to, because if we say, well, let's assume the market is going to return 0% or 40%, it's a guess. We don't know how good or how bad it is. So why not use all the probabilities available based on your asset allocation? So I think we can definitely model that better using the stochastic. Now, I want to be the devil's advocate. I think just about the only reason why, for example, you may not want to do that, especially if you are in the process of reviewing and possibly changing your asset allocation. Because even if Carolyn were to decide with the board, work with the board on the asset allocation, which have more or less the same rate of return, so 7%. But if that new asset allocation were to result in a lesser variability, standard deviation, then now we need to know that before we even do the stochastic modeling for you, because otherwise, I think our percentile distribution would be wrong. So there might be a reason why you may want to hold off on the stochastic, but it's really up to the board to decide when you want to do it and what kind of projection you want to do.
Thoughts? Deterministic, stochastic?
Comments, I guess. Does anyone at the table know if there's still bargaining units that are negotiations for?
Yes.
Yes, there are. Well, between that and the additional unknown of us possibly adding another asset class, I agree that the timing is almost correct, but
The timing will be the next question I'm going to ask.
yes, that I'm very interested in all of these reports, but the timing is my concern right now, with other bargaining units still in negotiations for potential raises or market adjustments, whatever they want to call them, reinstatement of wages for some people from pay cuts. And then the additional study we've been doing and consideration of adding an asset class, I think we're a little premature at this exact moment.
I'm going to get to timing.
But they could potentially be working on some of the historical data, then add the new data that we need to then complete the report. I don't know.
So, walking through we're in favor of doing a standalone report. Deterministic versus stochastic, I'm hearing a preference for both, which we would get with the stochastic. Is there general agreement there?
Yes.
Okay. Timing, right now, today is not the time to start our risk report. I mean, we could start it, but I don't think right now is the time. For me, the big difference is the experience study. That's the big demarcation, because we will be doing, the actuary will be walking through the experience study next year, early next year, where we review all of our assumptions. I think we want to have the risk report, and there are pros and cons both ways, but I lean towards, I think it's better to do the risk report after we do the experience study. So that we have all of the assumptions updated, we have the best information there, it will include everything at that point, so we do the risk report, this full stochastic risk report after the experience study. Andy, would you suggest that we wait until after the first evaluation to do it, or would it be immediately after the experience study before the next valuation?
I think I think the short answer is I would recommend that you do that before the 2020 valuation.
Okay.
And the reason being that it sounds like from the board discussion that there's going to be a substantial possibility for substantial deviance from our salary increase assumption. So I think we want to share that with the principal stakeholders, the county and the court, for example, sooner rather than later. So I think the best time to do that perhaps would be to give them a forewarning even before the 2020 evaluation, so that way they know, well, we just completed the experience analysis, the new assets allocation has been fully considered, it might change the rate by whatever amount, we don't know. But now we want to at least model the salary increases, something that we would have a much better grip in the second quarter of next year. And then we tell the county that, well, this could potentially happen, more than likely it would happen. And so the only thing that is not known at that point in time really is what happened to the investment return during the year, but we have that covered, it's part of the projection. So I think there would be some utility to do that.
Okay.
Yeah.
I think that makes sense, and that's something I think I can support. I don't think there's additional value in doing the standalone risk report every year. And just thinking it through, I think every 3 years makes a great deal of sense. Right after the experience study, a lot can happen in that 3-year period, but if we need to, we can write Siegel a letter and ask them to do something ad hoc for us like we did in 2018. So having thought through all of that, I think I would recommend the board adopt a motion to ask Siegel to produce a standalone risk report that looks at both the deterministic and the stochastic modeling and work with staff to determine all of the inputs and assumptions to take place there, and that we make it part of our process that we do that every 3 years after the experience study is produced. That's a recommended motion.
So move.
I'll make that motion. Without repeating it.
Yeah, no way.
Judy, did you get most of that?
Yeah.
Okay.
Yeah, and I think Quincy hit it right on the head too. There's this rate, I mean, this is significant. This is so significant, like nothing
Yeah.
that we've ever seen here.
Right.
We've had to go the other way, which we're not all that worried about because it helps us really in the long run. But this could go the flip side. Plus, when you put the investment earnings on top of that, that is a little concerning,
It's
yes.
gonna be bigger than Slavin was?
Oh, this is,
Yeah.
this,
Really?
well, Slavin, I mean, that's been a long time ago. That's had to have been, what, 25 years ago? Or,
Was it 2004?
I don't
So-
know, but this is big. I mean, they took whole, there was, and I'm not saying it absolutely was due, they took whole series, like, okay, an appraiser 1, 2, 3, they said, okay, appraiser 1, you're 20% out of market, everybody in that whole series goes up 20%. And they knocked off the bottom 10%, but then you're getting the rest of it over a 3-year period, 40%, 30%, 30%. I mean, it's significant. There are people there's people that saw a third, and then on top of it was a 3% cost of living. And so you're seeing there's people that are getting 10% a year for the next 3 years who have significantly been underpaid for decades. I mean, really, and it got worse over the last decade.
Procedurally, was that a second?
Yes.
Okay.
Yeah.
Is there any further discussion on the motion? Okay.
Who was the first motion?
Tim.
Tim.
Thank you.
All those in favor?
I,
Opposed? Abstain? Motion passes. Good.
Thank you.
Thank you, Andy.
Thank you.
Thank you.
thanks. Always interesting.
Thank you.
We'll be in touch.
Yep.
Thanks, Julie.
Do you want to take a break, or I think?
How does everyone feel? Would you like to take another break or just go?
Let's go through.
Okay.
Continue.
I'm usually the problem child.
So,
Jerry's not here. Me and Jerry, we're the problem.
You're the canary in the coal mine.
Right.
okay, so then moving on to quarterly budget update.
Thank you, Madam Chair. Trustees, you have the quarterly budget update before you. I'd be happy to answer any questions. No questions? Very good.
That works.
Okay, number 8, agenda item number 8, discussion and possible action regarding direction to Sarah voting delegate regarding the State Association of County Retirement Systems Fall Business Meeting, November 15th.
Thank you, Madam Chair. There are 2 items on which SACRS delegates will be voting at the SACRS meeting next month. First is Bill 783, and I recommend that the board direct our SACRS voting delegate to vote in favor of the motion to support SB 783.
So is there a motion?
So moved.
Second?
A second.
All in favor?
Aye.
Opposed? Abstained? Motion passes.
The second legislative item is a request from LA County Employees Retirement Association, as outlined in the memo. I do not have a specific recommendation on this item, but I recommend that the board give direction to the SACRS voting delegate.
As far as conversation's concerned, it seems from my review of that, even though it's in the initial stages, it seems like some of the language is rather outdated and not consistent with current medical opinions regarding alcoholism and substance abuse. So on its face value, I'm in support of potential language changes to that.
Yeah. It's more of a housekeeping type of thing.
I think I would agree with that. I think it's just changing it from medical to willful misconduct. So I mean, I don't,
It's willful misconduct to medical is what it's changing it from and to.
Yeah.
from medical to misconduct. It's talking about the intemperate use of alcohol. That's the current language.
Right.
Yeah. So I think what they're getting at is if somebody is committing some serious kind of misconduct, they shouldn't be entitled to get a benefit.
No, it's the other way around.
Yeah, I read it differently.
They're
It's
saying
removing the
That's
alcohol.
the current
People
language.
with alcohol and drug addiction, they're saying have been considered to be non-medical, let's say. And now the
They
move is towards a medical mindset of it's an addiction, it's a medical disease. And so to accept that, so it won't disqualify you from the non-service connected if you have alcoholism or drug addiction.
It's
That's how I
removing the language that disqualifies someone. So
Right.
no longer would you be able to disqualify them from a benefit.
Right. I thought the current language is the intemperate use of alcohol.
Yes.
And
Or
they're-
moral,
Right.
characterizing it as a moral failure.
Yes,
This is moving it to a medical perspective.
agreed.
Yeah.
So is there a motion?
I'll make a motion to accept the change of the language.
To
by
recommend,
SACRS.
to direct the
support.
voting delegate to support
Yes.
this proposed legislation.
Is there a second?
I'll second.
Any discussion on the motion? Okay, all those in favor?
Aye.
Opposed? Abstained? Motion passes.
Now, if I vote and I can remember the vote,
Good what?
You're just a yes man.
Yes, yes.
yes.
So are you gonna stay? Or
Yeah.
you are gonna stay? You're gonna be there,
I'll be there
you're gonna spend the night Thursday night? Okay.
So what have we decided about the voting delegate? Is it
Well,
Tim or is it
So
me?
Tim can, since Tim will be there, he is designated as our alternate,
Mhm.
but you
I'm-
can choose not to vote since you'll be on the dais.
Yeah. Is it conflict of interest or, no, not really.
It's not,
It's
because
not.
you have direction from the board here,
Yeah.
but it's just a
So-
little odd.
So if you're gonna be there, that would be good, because, yeah, it's
Okay.
odd, it's awkward.
Okay.
Okay. So, moving on to administrative report.
Thank you, Madam Chair. Trustees, you have the administrative report, update on how we made it through the public safety power shutoff.
Torture.
It could have been.
We made it through, benefits went out, everything was fine. I will say, there are current BCP, so yesterday I received an email from the CEO asking, it wasn't directed just to me, but all department heads to update their business continuity plan. And there was some language in there. So they're changing the process where it's I think the change is going to be that sending people home and directing them not to report to work is going to be, it will require CEO's approval for that to happen, rather than the department head
Interesting.
being allowed to authorize that. And there was language in the memo I received yesterday asking us to outline what we will do without power, including filing, cleaning workspaces, and those kinds of things. And our business continuity plan is clearly written as during a disruption, we focus on getting benefits paid and nothing else. And we've continued to treat it like that, so we'll have to work this issue carefully because it has the potential to create some conflict between the retirement office and the CEO's office. So,
I just want to add that, like, in our department, or our office, DA's office, everybody was required to come to work. There was no, no exceptions. And so, one of the things, this is from a practical point, not just for our department, but most departments also have laptops to do work So it's not, we don't just have to sit there. But, you know, again, every department works differently, so there are some, you know, questions. But I was a little, you know, I was thinking like, I can continue to do my work regardless of whether we have power or not, because I have a laptop. And I think a lot of people are in that situation. It's not like, oh my gosh,
Total
all
battery
work.
runs out.
No, we could, but even there, you know, there are things that you can do.
Well, work laptop though, because, I mean, people shouldn't be doing work, you know, they shouldn't be doing it on their private
No,
laptops. So, like in our office, they
You don't
don't have,
have
I mean,
laptops.
we have two, Julie and I have one, and then there's one for the office to share. But they don't have laptops, but we had our computers up anyway, because we have generators.
Right, so there's the other
Yeah,
option.
so we were fine, but like
Yeah.
in your office, were they required to use their personal laptops?
No,
Or do they all?
nobody was required to do
Oh,
that.
oh, I was
But
just
when
wondering.
in our office too, we don't have generators in the
Right.
courthouse.
Yeah,
Which is another, you know, I'm thinking if this is gonna be an ongoing situation, then we should all kind of, you know, plan, strategize how we can keep working when there are these things, because they are disruptive. Then after you're not working for a few days, you have this pile, this high of,
mm-hmm.
you know, so,
Life goes on.
yeah. So,
I know we previously had discussion about exploring alternate power sources. I had some conversations with the county after that, and they were not interested in, they didn't see the need for us to be thinking about a generator for our space.
right.
I don't know if that's something we should reconsider.
We didn't want to incur the costs.
Right.
I remember our discussions when $11,000 generator.
Even a cheaper one, I think that the emergency basis of we do the absolute necessities in a PSPS and assume that the general principle is they aren't gonna last more than 5 days normally. And we were right up to that, or some people exceeded that on this last one. And it's not cost effective to spend more money to stay on for non-essential functions during PSPS or other event that it causes us to activate that continuity plan.
Is the question whether it's on paid time or on vacation time?
That I
the
think is
question?
what's going to become.
And now
I
just
think
CEO,
that's-
now pushing for just CEO, before it was department head approval, now they're trying to get CEO approval instead of department head approval, so.
And then every department functions differently.
Different, right.
So it's
Right.
challenging.
Yeah. But the thing is too, for here, is you have telework. I mean, you do it, does Katie do
Yeah.
telework?
Occasionally at this point.
Yeah, so I mean, the thing is, if you're set up for telework, why would you need to come in? You would work from home if you could, if you
have
had
power.
Power
access.
at home.
If you had access.
Power at home, you
Yeah.
can work at home.
Yeah, but
yes.
you know, it seems like there's more and more, and I saw it with this last one, people were leaving. People were heading out, you know, out of the county, out, I mean, they were going other places.
Do you guys have
So,
evacuations?
no, well, we had a little slight
Yeah, we
Warnings.
did-
warnings
Hours.
in, warnings, but not
We
in
had
part of that.
actual evacuations in certain areas of Highway
Har-
20.
Harbor
That's
Valley,
true.
Those were mandatory, and then we
Yeah.
had warnings in others.
but not like a third of Sonoma County.
No.
Right.
That was crazy.
Yeah.
Yeah.
And I do remember seeing numerous emails during the PSPS where county officials were offering workspace to people that needed it, where there was power and there was connectivity to county systems
Well,
and computers.
Yeah, and they came to our office. Retirement was at our office.
Yeah.
Operating for, I would say, probably at least half of the time. If not more, we had people from retirement at our office. We set up space for them. So,
And we
Are they a
had,
good host?
we had coffee. We had hot
You
coffee.
did have coffee.
Was a little
And it was
crazy.
hot.
You had power.
Yeah.
yes,
No
that
heat,
spaces
no
too.
heat, but, yeah.
There was a time that the entire retirement office was in that little room.
Right.
Right inside of the door.
Right.
Yep.
Okay, so we will, I'll be looking at our business continuity plan and potentially making some changes to that, and we'll continue to move forward and get better every single time.
Right.
The benefit payment policy is attached to the administrative report. This relates to our discussion several months ago around during a disruptive event where checks a critical function. The board has directed that there is zero interest in incurring a $1,000 cost to cut 26 checks. So the benefit policy comes out of that and addresses, it requires direct deposit for everyone who retires after the effective date of the policy, which will be today. It does allow for the executive director to grant an exception in extenuating circumstances. There are still people who exist that are unbankable. Those people do exist. But strongly, requiring direct deposit, but allowing exceptions, notifying those who receive a check that it is going to be mailed on the last banking day on or after the last banking day of the month. It is particularly pertinent this month because the last banking day of the month is a county holiday. Those checks will not be mailed until the following Monday.
So,
So there's one thing I need to add, and I appreciate the desire and for all the reasons mentioned to require someone to not be able to do have a paper check. There is a code section in the 37 Act, not unlike most of the other sections, it's not 100% clear, but it does suggest that it's up to the member, because they can submit a revocable written authorization about how they want it deposited. So there may be a legal argument that would preclude us from requiring it, but I think the fact that the executive director can allow exceptions in circumstances maybe is enough. And I'm hopeful that since it's prospective only, that hopefully you're not going to get folks in the future who insist on a paper check, but there's a little wrinkle there.
So we
Full
are,
disclosure.
yes, full disclosure there. We created this as a staff policy rather than a board policy because we wanted the ability to amend it with relative ease. As I was drafting this policy, we started having discussions about can we move lump sum payments from checks to direct deposit. So we're exploring that option now, and hopefully we'll be able to do that, and we can move the majority of lump sum payments to a direct deposit in the near future. Some lump sums, rollover payments will always have to be, will have to remain by check for now, but it's our hope to move most of our lump sum payments over to direct deposit as well. Fiduciary liability insurance, or fiduciary liability insurance, I hope you all brought your checks. If not, you'll get a reminder next month to please bring a check for $9. You have the draft meeting calendar. We'll ask you to approve that.
I have a question on that.
Yes.
December 9th is like a really bad day in our office, it's like the worst day of the year because of property taxes. And probably even worse than December 10th. And so Julie and I cannot be here that day. There's no way that we can be here on December 9th.
What moved it up a week?
The holidays.
The holidays. It could be on the 16th.
yeah.
Yeah, there's no way. We're on phones. We're answering
Right.
phones.
Even if it weren't on a Wednesday and it was on, say, like the 14th or something, if you wanted to keep it still farther away from the holiday.
I think
The 9th is
Wednesdays are going to present the least amount of challenge because that's our
And the
consistent
third,
day.
which normally is the third Wednesday anyway, so
Yeah.
if there's a reason, yeah, that we can, just to say, two of us won't be here right out of the chute, so,
But is the 16th okay?
yeah.
I think it is, but I think
Except
it's
for
also
Raleigh.
important for us to have as many members here, because it sounds like it's gonna be a rather big.
Well, this is actually
Next
next
year.
year.
This
this
is
is-
next year, I'm sorry.
Yeah, this is a year
But
from
still,
now.
We already
the
have
report
that
will
date
be,
Yeah.
sounds like our timing will be the
But
same.
approving it,
Correct.
yeah.
Same important day.
Yeah.
I was gonna say the 16th is on a Monday. Wrong year.
Well, if we're approving this, I just want to put
We're
that
not
out.
approving it today,
Oh,
we'll
okay.
approve it next month.
Oh, okay.
Okay.
It's just
Okay.
here for information and discussion purposes.
Okay,
Okay.
So it sounds like we'll move it to the 16th.
okay.
So
Thank
is-
you.
Is there a reason you wouldn't move November's back to the 3rd? Because it doesn't conflict with the,
With SACRS?
yeah, it doesn't conflict next year. Anyway, just a thought. Because that's only 2 weeks from the previous
Yeah.
meeting.
Yeah. Is, yeah.
The 18th on November.
Oh, yeah.
Oh,
It's
the actuary, the actuary. The actuary's not available on the 18th,
Oh.
and that's when we get our actuarial evaluation.
They do another county that they've had
Yeah.
longer.
So that's
That
why.
pays them more.
Because it's larger.
I don't know if that's true or not, but it's Sacramento County.
Yeah,
So-
that would be-
So is November gonna present a problem for anyone, being on the 4th?
Okay, we will make that change before we bring it to you next month for approval. And finally, office hours, as we've done in past years, we will be closed to the public on Wednesday, the day before Thanksgiving. Employees are allowed to use accrued leave for that day, or if they wish to be here working, they can be working behind the scenes. We have plenty of things for everyone to do. And then early advance look, we will probably close, I think the county is going to authorize closure of the entire week of Christmas. Closure to the public. Only Christmas Day is a holiday. But they'll authorize closure for the entire week, I think. So that concludes the administrative report, Madam Chair.
Thank you, and is there any general board discussion?
Do we have any news on these two as far as when's their last meeting or
I
what?
think today might be my last
Oh,
meeting.
no, really?
He's
Are
smiling.
you not, because you're not here next week, next month because of your own birthday? Uh-huh.
Well, we'll miss you very much.
So you continue to serve until replaced, but I don't know,
Let's just never replace them.
I don't know
There we go.
what the appointing authority plans in terms of replacements. I've heard nothing. Well, I know that there is work being done, but I know nothing beyond that.
Maybe that's where Dan is today, he's out shopping.
Should I respond to the board? I got a letter from the board reminding me my term's up. Would you like to extend? Should I
Oh.
respond to them, or is Dan gonna?
They're aware.
Okay. So,
They are well aware. They've been aware for weeks now, so.
Don't go.
Yeah.
Since you
Change
broke our heart, they've been aware. So,
I miss, well, it could take a long time to
Yeah.
sell the ranch, so.
Hopefully. Not for you, Brian.
Just put a very high price on it.
Yeah.
It already is.
Yeah, if I win
It's
the
just-
lotto, I'll buy it.
Okay. When you drive down Hopland, you know, you hear that sucking sound on the west side, it's not the geysers.
Well, thank you guys both. If this ends up being your last meeting, thank you guys both.
Yeah.
oh,
We will definitely miss you guys. Well, it sounds like she's not coming for sure in
I'm coming
December.
back.
I'm in December
You,
for
yeah.
it might not be the last time we see them.
sure. But you won't see me in December, no matter what.
Yeah.
Understood.
Okay.
Any other discussion? Okay, do we need a motion to adjourn?
You can declare us adjourned, Madam Chair.
Okay, I declare the meeting adjourned.
That's what I said.
All righty.
Just let both of us go.
Um,
Something I feel like